Hey guys, it's Jordan with Cashflow AI, and in this video, we're going to talk about how to sell puts to generate income. And really, this is the only video you're going to need because we're going to cover how to do that. We're going to show you the exact selection process, how to use credit spreads if you have small accounts, all the risk management needed, and a complete checklist in the video that you can use to print and follow and generate weekly income. So let's dive into it. So how do you actually generate income from selling puts? Well, I'm going to dive in the charts and show you the options channel, show you an example, but to separate it out really simply, step one, you're going to sell a put option, and what you're going to get is a premium. And so that's when the broker actually pays you money instead of you buying something. So you could do one for 50 bucks, 100 bucks, 200 bucks. But let's say in this example, you collect $50 in premium. Now that's essentially your money. You're essentially borrowing that. You're always going to sell it at a strike price. And if the stock stays above that strike price by the expiration, you're going to keep that $50. You basically just make that $50 every single week as long as price keeps going up or stays above that strike selection. Now, if price ever drops down below that selection, what's going to happen is you're going to get assigned 100 shares of stock. But you're basically getting it at a discount. So it's kind of like the same thing. You're still getting an advantage because you only really want to do this on the stocks that you are comfortable holding long term. And I'll kind of go over how you can actually not do that and still make money using it. But that's really the core concept here. So you basically, all the premium you get is all the cash you make, and that's how you profit every single week, every single month that you're doing this. So let's take a quick example on Apple, and I'll go in the charts and show you in a second. But let's say you have Apple's trading at 180, you're bullish, and you say, I like Apple long term, and if it drops to 170, I'd be a buyer. I like it long term, I'd hold it there. So instead of just buying right there at 180, what you could do is sell a put at the 170 strike price. And let's say it's 30 days out, and let's say you get it for about $87.50, right? So you're going to collect $87.50 premium. You're selling one contract. You are going to need quite a bit of collateral, but again, you're trying to get 100 shares anyways eventually. And so really, as long as price stays above 170 after those 30 days, you're going to collect that $87. And that's going to give you about 6.2% return annually. That's cash in your pocket every single week or every single month. So again, if Apple stays above 170, you're going to keep that. If Apple goes below 170, well, you're going to get 100 shares at that 170 price. And again, the advantage here is that you're doing this while Apple's at 180, right? So if price keeps going up, you're going to make money. If price dips down, well, instead of buying at 180, you're now able to buy it at 170 because that's when you sold the actual shares at. So now let me show you a live example in the actual charts. Okay, so this is Apple on a daily chart when I'm filming this video, currently at $251. So let's say, and I also have the options chain pulled up here. So let's say that you decide you want to sell a cash secured put 1 week out. So if we're on Apple, we want to go to 1 week out. So we'll just go 9 days out and make it a little bit easier because we're currently on a Wednesday as I'm filming this. So 9 days out. And let's say we want to get, something that we have a strong chance of not getting assigned, right? And so we can just look at the delta, and typically somewhere around like an 11 delta, that's going to give you about a 90% chance that it won't get assigned, right? Or 11% chance that you do get assigned or price ends up in the money. And so right now I can get these, I can sell one for about $59, okay? And so if I look at this is the 237.5 strike price. So if I go ahead and draw a line at 237.5, that's all the way down here. And basically what this means is that as long as price in the next 9 days, in fact, we can actually draw this out. So we go to, let me see when this expires. It'll be October 24th, which would be right there. Okay, so in the next 9 days, as long as price stays above this 237 level, it can go all the way down here, up here, up here, it can go anywhere around here. As long as this happens, I'm going to make $59 of passive income. Not too bad, considering that in order for me to lose money, and not necessarily lose money, but get assigned to my shares, price needs to drop basically 5.5% in the next 9 days. And again, anytime you're taking a trade where you're betting on a over 5% move in 9 days, especially on a stock like Apple, it's unlikely to happen. And that's why you can able to get this for simply $60 as opposed to one like, the 250s, which you can get $300 for, but there's a good chance that price can go below 250 in the next 9 days. So that's really what I'm doing here is taking advantage of these cash secured puts. And as long as the stock keeps trending up, I can keep doing this every single week and keep, leveling these up and buying these puts every single week. And that's how I'm able to make these gains. And so you can do this on multiple time frames. If we look at SPY as an example, you have the 7 DTE and the 30 days expiration, same strike price, but Obviously, if you go further out, you're going to make more money, but you can make $57 every single week you're doing this if you're getting it 7 days out, right? Let's say SPY is trading at 450, you can sell that weekly put for income. But the thing is now SPY and QQQ trades every single day options, 0 DT. So you could basically do this every single day and collect daily passive income as long as SPY or QQQ stays above that strike price that you're selling the put at. And because SPY and QQQ have very good spreads, a lot of volume, they're typically one of the best ones to use for this strategy. So let's say you have a small account and you don't have $17,000 to sell a 170 put on Apple. What you can do is actually turn it into a spread. And this is going to cap your risk, but it's also going to allow you to still have that same chance of making that passive income. So let's say you still sell that 170 put, right? You're going to get about 90 cents in credit. Now, what you can do is then buy another put that's at a different strike price. You can buy one that's cheaper, right? So we sold one for 90 cents, which is a little bit more expensive, and we bought one for cheaper for 30 cents. And so that spread, that difference there between 90 and 30 is your $60. That's how much you can make on the position. And your max loss is $940, right? So you only need to put up $1,000 of buying power here, or really $940 of buying power here to make $60, right? And it's not necessarily that you're risking $940. That is your max loss. But if you use good risk management, you have stop losses in place, then you shouldn't need to worry about that. You can always manage your risk and basically decide how much you want to lose on each trade. But this way, you don't need $17,000 to make this trade. All you need is $940, and you make $60 every single week. And again, if you're doing this on SPY on 0 DTEs, you could do this every single day. And that's where the real compounding comes into play. So there's something also as cash secured puts versus put credit spreads. And so really the biggest difference is that you really want to do put credit spreads if you have a small account and you don't really want to hold the shares long term, right? Like you only want to do cash secured puts on different stocks that you like long term, because you're going to end up owning 100 shares if the stock decides to tank. So you have to be okay with that, and you have to have the capital for that as well. But if you just want to take advantage of short-term volatility and you don't have that much cash, put credit spreads are typically the better way to go. Now, managing the trade is also really important. You don't always have to let it expire worthless. You can always take profit a bit early. And because options always decay, every single day you're essentially going to make money even if the stock price doesn't move. So just like before, right, if you get a credit spread, you get filled at $60. You don't have to just make that $60. If tomorrow, the next day, this drops to $50, you're going to make $10 in profit. You can take it right there, right? So a lot of different ways you can do that. You can always close and roll it as well if you don't want to do that. So if the price dumps, and let's say you're in a cash secured put, you can also just roll it, which means you basically sell it or buy it back, and you get the next week's expiration, and in hopes that price comes back up, right? So you can kind of roll it out for additional credit. You can do time-based exits. So if you're doing 30 days to expiration, you don't want to exit at the 30 days. You could wait till 5 days before, 3 days before, go from there. That way you can avoid certain assignments. And those are kind of like the three really rules that I use to help manage the trades and manage exits when trading these strategies. Now, there's another thing you can do, which is kind of the wheel strategy. This is like the flywheel that a lot of big traders do. And so let's say you sell a cash secured put, right? And let's say the stock dumps, okay? Now, what you can do is you can, because you're going to own 100 shares, you can then sell a covered call, which is basically selling a call above the strike price and doing kind of the opposite of selling those puts. And then if you get assigned on that and price goes back up, now you can go back to selling cash secured puts because you won't have the 100 shares again. In fact, let me show you an example of what that would look like right now. Okay, so we're back on the Apple chart. Now let's say, for example, price is trending up, and on this day, we decide to sell a cash secured put right at we'll call it the 250 level here. Now, and let's say we get into that right on this day here. Now, the next few days, price dumps, and so what happens? Let's say on this day, right, on the 13th is when that expires and we get filled. So now, at this point in time, right here, we now own 100 shares of Apple, right, at about 250, because that's when we got the strike price for the put that we sold, right here at 250. So now we own 100 shares at 250, and so what we can do now is, now that we own 100 shares, you can sell a covered call. And what selling a covered call means, you sell a call on the opposite side. So what I can do is say, let's say, for example, we sell the 260 call, and we go back to our chart and we say, okay, for 9 days out, same thing, the 260 call, is right there at $100 or 110 to 112. So we can sell this for $110, right? Now what I can do is sell the 260 call right here. And as long as price stays below 260, I'm going to make $110, right? And if price goes way above 260, well, what's going to happen? I'm going to have to owe and sell my 100 shares that I just got at $260. So now I'm in a position where I bought at 250 or own 100 shares at 250, and I'm selling them at 260, and that's if the price really, rises, go all the way up here. I still made $10 per share on $100. That's $1,000 I just made, right? And that's, again, you're doing this on stocks that you like long term, so that's where it tends to make sense. Now, again, let's say the other thing happens. Price doesn't go above 260 and it goes up to 250, goes down, goes anywhere around here. Well, now I just made $100 through passive income by selling this call because this is going to expire worthless. So you can kind of keep doing this and rotate this strategy. It's kind of like the flywheel that I was just showing you, where as long as you keep doing this, you can obviously still lose money. It's never a can't lose strategy. However, you can set it up where you're able to get passive income, and if you're right, the stock keeps moving higher, and you want to own the shares anyways, you're still going to make money and capitalize on that move. Now, some really simple mistakes that a lot of people do. Number one, selling in the money puts by accident. You always want to do out of the money. I mean, you don't have to, but it's really recommended for most people that you sell out the money, because if you do go in the money, there is the risk of assignment. Always check for earnings as well. You don't really want to do this into earnings because things get a little bit crazy. It's not really worth it, in my opinion. High premium as well. A lot of people say, you can sell a put that's closer to in the money than one that's further out of the money. And, you're going to get more premium. You're going to make more cash, but there's a lot more risk of you getting assigned and not making money on that trade. Always have an exit plan, right? If you want to take profit of 50%, you can do that. If you want to let it go 100%, you can also do that as well. And then oversizing, again, there is risk involved as always. You want to make sure you're not risking your entire account on one trade because one bad assignment can wipe you out if the stock really decides to dump. And so now for the final kind of step-by-step checklist that you can use to actually go ahead and start using this strategy. First thing, choose a quality ticker, okay? Liquid, large cap, something that you're comfortable owning long term. Again, verify the liquidity, make sure there's a tight spread, high OI volume. You can typically do this just by looking at SPY, QQQ, Apple, Tesla, Nvidia. All the big name stocks are typically very good with this. Check earnings calendars, right? If you know that earnings is coming up in 30 days, sell a cash secured put that's 7 days or 14 days out, right? You don't want to really deal with all the earnings stuff. Obviously, if you have a strategy that's not just like randomly selling these puts, like using support, moving average to RSI, that's going to help you as well. Have a proper select strike and delta, so know your numbers. Calculate position size. Don't go all in on a single order. You definitely don't want to do that. And make sure when you are placing your orders, you're doing limit orders. You don't want to market order into these because there's always the risk of getting a really bad fill. You don't want to have to deal with that. Setting take profit at max credits if you choose to do that. Log all of your trades, right? Have a journal, and obviously monitor daily, adjust. It is technically passive income, but you always want to monitor it. You don't want to just let it go and never touch it again for years and years on end. So make sure you have that going for you. So hope you guys did enjoy. Leave a like and subscribe down below if you're interested, and I'll see you all in the next video.